John Williams, President and Chief Executive Officer of the Federal Reserve Bank of New York, speaks during an Economic Club of New York, ECNY, event in New York, U.S., on Wednesday, March 6, 2019. The Federal Reserve can afford to wait and watch incoming data amid a slowdown in U.S. economic growth before making another monetary policy move, said Williams. Photographer, Mark Kausler/Bloomberg Copyright 2019 Bloomberg Finance LP zero increases for Fed funds in 2019, and no more sales of bonds after September. That's the latest monetary policy guidance from the U.S. Federal Reserve. It ends the tightening cycle that saw the first rate increase in December 2015 but really began in May 2013, when then Chairman Ben Bernanke ended quantitative easing. K was the Fed policy of buying bonds to push down market interest rates. And by the post-2008 financial crisis peak, the central bank held $4.5 trillion on its balance sheet. The plan now is to cut that to $3.5 trillion by the end of September, and then hold steady while refinancing maturing mortgage-backed securities with U.S. Treasury paper. The total Fed funds increase was 2.25 percentage points. That compares to 4.25 points for June 2004 to 2006 and is the lowest for a tightening cycle in the post-World War II era. It's also by far the longest duration period of tightening, starting from the reversal of K. Chairman Jerome Powell couched the move as aligning policy with the Fed's inflation target of 2% annualized, but the change will leave balance sheet bonds at 17% of U.S. GDP, versus just 6% in June 2006 at the end of the previous tightening cycle. That raises questions about how the central bank will be able to fight a real economic slump. Fortunately, only 2 of the 10 factors in our forecasting model currently point to a recession in 2019. And one of those, Federal Reserve policy, will reverse shortly, unless the central bank changes course again. With no recession, the bull market in stocks won't end anytime soon. And investors will be best advised to use the dips to build positions in strong companies, rather than to run for the hills. Those who took advantage of the market's December holiday season lows are already much wealthier for the effort. The S&P 500 is still about 3 percentage points below its late September 2018 high, but is up 24% from its low point. Concerns about global growth triggered that sell-off. Emerging evidence that slowing even in China won't be as bad as feared inspired the recovery, along with generally solid calendar fourth quarter 2018 earnings. The Fed's news this week has obviously spurred buying. And we see multiple potential catalysts for more gains well into the summer. Those include a prospective US/China trade deal, muddling through Brexit and another solid earnings reporting season that kicks off in less than a month. But so long as our forecasting model says no recession, our focus will be on the health and growth of companies' underlying businesses, whether they pay dividends or not. There's persistent conventional wisdom that sectors like utilities and REITs are bond substitutes, and by that reasoning, they should especially benefit from the end of this tightening cycle. I'll go along with that in one very important respect. Mainly, these sectors are major sellers of bonds, both to fund new capital spending and to refinance existing debt. The Fed's announcement this week has pushed the 10-year Treasury note yield to its lowest level since the beginning of 2018. Since bonds issued by utilities, REITs and other dividend payers are benchmarked to Treasuries, this is a potential major opportunity for companies to issue bonds at lower rates, cutting interest costs and thereby boosting earnings. There's potentially an even bigger opportunity for the handful of investment-grade energy midstream companies like Enterprise Products Partners, EPD, and Kinder Morgan Incorporated, KMI, to do the same. But it's unlikely to extend to borrowers with sub-investment-grade ratings. In fact, the going could get tougher, if investors perceive the Fed's policy change as a tacit warning of an impending recession. What's patently false, however, is the persistent popular narrative that dividend-paying stocks' prices always follow interest rates and Fed policy up and down. The Dow Jones Utility Average, for example, traded around 550 when Fed funds increased for the first time in December 2015. Just before this week's zero increases announcement, It hit a new all-time high around 780. The JUA did even better from June 2004 to June 2006, returning nearly 60%. During both tightening cycles, utilities benefited from a strengthening economy just like the rest of the stock market, which the Fed was responding to by raising rates, and earnings and growth will continue to set their course going forward, even with the Fed standing pat. The Fed's considerable influence on the economy means it can certainly affect these factors. And all else equal, what it announced this week is bullish for stocks and bonds. But make no mistake, there is no lockstep relationship between Fed policy and investor returns from dividend-paying stocks. Need more proof? The JUA managed double-digit total returns in 2009 and 2013, both years when the Fed raised rates and the 10-year Treasury note yield